I will make the distinction very clear. Angels are normally the people who are not regulated. Okay, these are like high net worth individuals who just put their own money as a risk into the company. Okay, they put their own money, while private equity funds or VC investors are usually the guys who get people's money to be pulled up and put into the company. Is this distinction clear? So when you're playing the game on your own money, SEBI and all the people in the world are really not bothered. It's your money, you burn it, you throw it down a bridge, into the river, whatever you want to do. But when you're going to be collecting people's money and put it into a particular place, all the regulators will stand up, isn't it? So therefore, PE and VC investors are the regulated investors. Okay, and the regulated investment is regulation applicable is SEBI Alternative Investment Fund regulations. Now in there is a talk of an angel fund, but again it's a talk of a fund. Okay, so fund is where people's investments are pooled up. Here we are only talking of angels who are just putting their own money or stake into the company. So in this case, these guys will fall into the category of angels because they are thinking of putting their own money into this entity. Okay. Are angel investors, private equity investors, and venture capital investors regulated? I just told you who is regulated and why they are regulated. And if yes, how? I just told you how they are regulated. Okay. You can bring this into your answer with the entire logic. How does this make a difference to an investee company? Because that in case of regulations, there are going to be limits on what they do and how the investment is structured and framed out, isn't it? It has to be in accordance with those regulations for the investee company. In case of angels, there's not going to be much regulations. In case of PE and VC, there's going to be regulations. But the basic gap again in PE investors and venture capital investors, and I was talking this morning to a lady who frequently deals with this, and the way she put it is that venture capital people will be the guys who come in at really early stages in an entity. All right, it's really an adventure for them. And PE will be the guys who come in when people are looking to scale up their business. Okay, so it's like at a secondary level where they already have some sort of a standing, they already have some sort of a clientele, and at that point of time, they're looking to scale up, they're looking to grow, go to the next level. That's when the PE guys will come in. Okay. And the way few insights that she gave me, I really want to share with you guys is that when PE guys come in, they really want to take out or buy off all the angel investors who are there, the people who have put in their own funds, and they will have resources to do that as well. And they may even buy off the venture capital investors shares, and the venture capital guys will actually be happy to sell them off their shares because the PE guys will be taking that next level thing into the company. Venture capitalists and angels will probably step in more or less at a similar kind of time, like in the very initial stages of the company. So, but yeah, venture depends on who is stronger, and venture capitalists can buy out the angels and PE guys can buy out the other two. Yeah, this can very much happen in the company.